Do not be fooled, Moon Platoon. What's going on, guys? At the end of this video, I'm going to tell you why we are paying attention now more than ever to the real estate collapse. Something that has happened in 2008, for those of you who couldn't remember, and those of you who have just now started on their investing journeys, welcome. My name is Andrew. That is Professor Meatball. We are data scientists here in Silicon Valley, and I want you guys to understand that we're going to talk about data in this video. So if you like that, make sure that you have already slapped that like and gotten the word out, because there's going to be a lot of text here, but we're going to make it as clear to understand as possible. Not only telling you exactly about what the commercial mortgage-backed securities bomb was, but what it is going to be. So pay attention. Please make sure that you guys have already, for Meatball's sake, done a little bit of a commenting, which like you guys down below, and telling you which part of this video really resonated with you. First, let's talk about the part of real estate market that's going to bust. CMBS, commercial mortgage-backed securities market. These are the loans on commercial buildings that have been securitized, bundled, and sold to investors. The following is an explanation of this issue that this author wrote in this DD over 6 months ago. This one is a little bit different from the mess that we had in 2008 with mortgage-backed securities, MBS, because it's a different market with different rules, but a smaller total market than MBS. That said, the problems here might actually be worse. This is a company called Ladder Capital, formed out of the remnants of the Bear Stearns bond department that has struck an unusual deal with Dollar Store, and they have a lot of properties that are very, very much coasting on made-up mortgages. They could write easily about 3 pages on this partnership alone, but just to summarize that instead, say that these people have learned absolutely nothing from 2008, except that it was a profitable scam that carried no jail time. To understand how bad the CMBS market is, you have to understand how CMBs work. At first glance, they're similar to regular MBS. It's bundle of tens or hundreds of mortgages for commercial properties. They're divided into tranches, usually 6, and the lowest tranches pay out about highest yields, but also fail first. Now things start to get a little complex. Let's make sure that you guys have already followed up there. You can bet on a couple of mortgages just like stocks if they're bundled together. That is mortgage-backed securities market. However, now we're looking at even larger bombs, because if a cascade of those mortgages fail, then the investment that whatever purchase guaranteed your yield against those mortgages will also fail and be worthless. A commercial building is an income generating property. It's a market value and is derived from how much income it generates. The bank lending you the money will want you to put up some of the amount of collateral for the loan. If rents go up, the amount of collateral you have to post goes down. If rent goes down, the amount of collateral you have to post goes up. So the weird thing about CMBS loans is that only if half your building is rented, you can just pay half your mortgage, and whatever you owe for the other half of the building just gets added to the end of the loan. Now, say you can't rent out the empty half of your building and you want to renegotiate the terms of your loan rather than adding back the debt to your loan. Well, this is where CMBS comes into play, because all those different tranches that we just mentioned, the investors behind them have different incentives. The guys at the lowest tranches don't want you to modify the loan because that means losses, and they take losses first, while the guys in the highest tranche want to modify the loan because it generates more income for them and they're not eating any losses. Unfortunately for you, in most CMBS agreements, you need a supermajority of 70 to 80% of the votes to get a loan modification. So to lower rents to market rates and to get the building rented out, since you can't get a loan modification, you, the landlord, have to write a check to the bank to make up the difference between the value of the building at the old higher rental rate and the value of the building at the new lower rate. Or you can just do nothing and get an extra write-off on your taxes and hope some sucker comes in and rents the higher price at a different sucker comes in and buys the place from you, making it their problem. This is why you'll see so many empty storefronts with ridiculous asking prices that the landlords don't budge on. It's because they can't. So really skim down on the teeniest top of the surface of that subject, but basically those CMBS notes that are super toxic starting March of 2022 are going to be absolutely detonate the commercial property market. Many banks and investment groups will be destroyed when these go bad, just like in 2008. The video of the empty stores in NYC, we can take a look in a sec. This is a video from a guy who walked around downtown NYC showing empty stores. It basically looks like a dead mall now. Back in March 2022, when these bad CMBS notes were starting to detonate and causing problems, let's check and see if this is a little spike at the end of the Head and Shoulders before it really dives into all-time lows. That was the last day of February 2022. All right, some technical analysis. We'll do some at the end of this video as well. If you guys are paying attention to the Monday markets for AMC and GME, or for what stocks you guys care about, comment that down below. So we can do a little couple of suggestions. Okay, so that's a third of the US real estate market. What about the 2/3 of the market that's residential? Well, this is when it gets weird. Everybody keeps missing it. They've written about this issue with the US housing market. Housing units relative to population has actually increased over the last decade plus, while home ownership rates have dropped and prices have skyrocketed. Everyone who looks at the residential markets now think that it's being bought by residents, and all of the people buying today are actually qualified buyers with good credit and jobs and such. And that is true for the people buying houses. There is not a repeat of the 2008 subprime debacle with NINJA, no income, no job, no assets loans. What is new, and whenever you get a financial crisis, it's always driven in large by new types of financial instruments. Read debt. Is the sheer number of homes being bought by cash. And it's inferred that these institutions and foreigners, right? So for example, about $90 billion in US real estate was bought by foreigners in 2021. Wall Street, however, blew that away, hitting as high as 1 in 7 of all homes and 1 in 2 of all apartments. Now people look at that record institutional foreigner buying and think it's the explanation, but the truth is, even with those crazy numbers, 6 in 7 homes and 1 in 2 apartments are still being bought by regular people, often with, again, cash. These purchases are frequently referred to as cash buys because the buyer just pays the seller cash. However, they don't actually have piles of cash lying around. They take out loans. Specifically, they take out loans on their equity assets. Now is where it gets getting a little sticky because institutions are not buying these houses and apartments as residences. They're buying them to generate income. In traditional home mortgage loans, there are 2 things assessed: the value of the house, which acts as collateral for the loan, and the borrower's ability to pay back said loan via wages or assets. It's a relatively simple 2-factor risk analysis. Now, let's look at what risks the Wall Street-owned rental homes are subject to. 1. Income-generated rental rates. 2. Home values, stock derivative values, interest rates, urban planning, crime rates, and overall market returns. So basically, the money being loaned is getting assessed on a 1-factor risk analysis, value of assets under management, AUM of the borrower. But then the money is getting used to buy a whole bunch of houses and apartments, and all of a sudden, it's subject to a whole horde of other risks. And the original risk profile is more useless than you are when you're compensated evening companionship after a couple of drinks. Kids, don't look that up. If you're just starting your financial journey, no need of reason to look that up. There's one other thing I haven't mentioned yet, and that's huge. The reason Wall Street never really messed around with buying up everyone's house before the 2008 crash, and it's a big one: liquidity. More specifically, liquidity of assets. Let me say that one more time. Liquidity of assets. What mean? Glad you asked. Liquidity of assets, LOA, basically means how easy or hard it is to sell an asset. Now, one of the reasons Wall Street hedge funds and investment banks can do things like leverage up 37.5 to 1, the theoretical max level that they use, or say 200 to 1, the level that Goldman is using according to the last 13F filing, is because the money is backed by securities and derivatives and other financial instruments, which are extremely liquid. So if things go up like the Titanic, the lender can force a sell-off of the stuff very quickly to get their money back. In reality, this isn't true. Like in Credit Suisse or Nomura wouldn't be dragging around Archegos bags from last year, and Bill Huang couldn't have pulled a Reddit meme and avoided margin calls by not answering the phone, which is in actuality what happened. But in theory, it is. Now, housing is illiquid. It takes a lot of time and effort to sell a house or to buy one. There are special rules and whatnot from the federal government and what kind of collateral and stuff you need for a residential house. 2008 was so bad because the banks basically ignored all of those. After 2008, one of the few things the government sort of did fix was tightening up lending standards for retail regular people. So everyone who's looking at the last crash sees the retail borrowers aren't over-leveraged with bad loans and subprime thinks it can happen again. But all those rules and whatnot get ignored if the buyer is paying cash. This is the financial equivalent of the military expression, generals always fight the last war. The massive use of margin equity-backed loans by both retail and institutions to buy property has taken 2 separate markets: the liquid and volatile equity market and the illiquid stable housing market, and stitched them back together like a human centipede, wrapped in poop, passing back and forth in the market. One market is unequally illiquid and extremely price volatile. If you need proof that's what's happening, let's find out some charts to illustrate the point. Here's the US margin debt over the last few years. Now let's compare it to the US housing prices over the same period of year. Yeah, you're probably saying that there is a contradiction here. Basically, we have loans on inflated assets fueling loans on other inflated assets. This is a feedback loop that goes parabolic. then crashes hard. You can see margin debt coming down and forming the first valley before it goes back up to complete a head and shoulders pattern, then drills down to the center of the earth. Because housing is a liquid, it's going to lag that drop, but as you can see from the price curve leveling off, it's getting ready to do the same thing. So if you guys want to be able to fully go through this article, I want to be able to leave you with this snippet. I'm going to say that this is the reason why margin calls are coming soon. When the markets are crashing, all of the shorts that still exist are still going to send the stocks that are overshorted skyrocketing. So at the end of the day, understand that this is a part of the margin call squeeze, the mixed squeeze theory. If you guys want to find out more theories about the different ways the financial markets work and seems to have been served with the data that backs up these theories, go ahead and check out the channel. Hit a subscribe and the bell button if you guys enjoyed this video. And if you guys want part 2, comment that down below as well. Thank you guys. Happy Sunday, and we'll see you in the money. Peace.